The fact is that markets fluctuate in a big way. How do we safeguard our money from these fluctuations? What should we be doing? What kind of solutions should we look at? How is it that we need to exit from our mutual funds? What is the best way? So many questions. Answers will be given by Dhirendra Kumar. My name is Rajesh Lake. And to tell you that Investors Hangout is brought to you by Aditya Birla Sun Life Mutual Funds and Value Research. Dhirendra is the CEO of Value Research, and he has a very difficult question coming his way, and that is, how should we withdraw from mutual funds?
Yes, what we saw was, markets went down a little bit, or, went down for a couple of days, and investors just run for cover. They think that,
Yeah.
they wish they could have, uh, been able to, they should they sell? They are faced with this question. They see the investment value going down. And big market movements, that should not be a driver of your for your need to sell, because many people get scared when you see your investments going down in value by 5%, 2%, or
Correct.
1% every day. But that definitely should not be the case, because that is exactly why you invested in the first place, to optimize your return or maximize your return. Market fluctuation is very much an integral part of it. Markets will fluctuate. The key thing to ask is that there are reasons why you should sell your fund. The primary reason is when you need the money. The
Fluctuation, no fluctuation.
Fluctuations or no fluctuation. Or if you are reorganizing your portfolio, your needs have changed, your needs were different, and now it has changed. So you need to really sell your fund and buy some other kind of fund which is more appropriate for your current conditions. I think the third reason to sell is when your funds are doing poorly. You have a fund, and when you bought it, you thought that you did the diligence, you saw the ratings, you looked at the performance, you looked at how consistent it is doing well, and after you bought it, after a couple of years, you find that it is no longer having those variables. It is not doing well as it used to. So when you should sell your investment? That is the question. I think these are the reasons why you should sell a fund. Markets going up or down, markets are like that only. Markets will either go up very dramatically or will go down very dramatically. And if you are trying to time it perfectly, if you want to avoid this decline, and if you want to only ride the gains, it is not possible. You will not be able to realize the benefits of investing in equity.
So what I hear is that market fluctuations should not be the reason for you to sell. Your need is the reason why you should be selling.
Yes.
All right, moving on. Is there any method in which you should be redeeming from your profits? Mutual funds make profit. Now, is there a methodology involved in that?
There is a method. But for that method, you have to really pre-state what you have set out to do.
Okay.
Because if you don't set out a goal for yourself, depending on your goal, many people don't have a goal. It is just a long-term investment for your retirement, and you are still in your income years. You don't depend on your investment, so it doesn't matter. Then you carry on. But if you are investing for a specific goal with a defined time frame or a defined amount of money that is needed, then you should sell. You set out to actually put together your down payment for a house, and you thought that you'll be able to do it in 3 years, and it has happened in 2 years' time. You by all means take your money out and go ahead, and because there is no greater success than actually achieving a goal. That's one. You reach a goal, take your money out. Don't get greedy at that point, that if the money is going up anyway every day. Then the other, there are other things, there are other situations. I listed 3 reasons. When your needs change, or when the fund actually stops performing. That is something where you should have objectivity. The reason why you choose a fund is, it has, we talked about 2 weeks back that how to go about choosing a fund. It is doing consistently well. It has a superior rating. And when you look at those 2-3 variables when to choose a fund, when they slip for a prolonged period of time, what is that prolonged period of time? Should you really take note of just market going down? May not be a good yardstick to evaluate a fund on. Because if market goes down by 5% in a month's time, and if your fund has gone down by only 2%, your fund has done exceptionally well. and the reverse situation. You have to see that what time frame you will take. I would say that don't get out of a fund in a hurry just because the market is going down. Yes, on a relative basis, if it is doing poorly consistently, for a relatively new fund, I will give it a 1 to 1.5 year time frame. If it has done very well in the past, and off late it has started doing poorly, but not a very old fund, 5-6 year old fund. If it's a 20-year-old fund, it has an impeccable history, a great track record. 18 out of 20 years it has done exceptionally well. 1 or 2 years of bad performance, I will still not exit. I'll be inclined. Of course, you have to see that the fund manager is still there. There are red flags. You have to see a couple of things that when things become, when you should be worried. But beyond that, I think one should not be getting in and out of a fund. Many investors, there are other situations. Many people have too many funds. They are not an investor. They just become a collector. And too much of diversification may not be in your best interest. Your investments might become almost like an index fund. Your underlying investments could be so widely spread that it is a very wrong form of diversification. So maybe getting rid of some funds to consolidate your portfolio, to have the manageability, to be interested, and to be able to keep track of it well, might be, that is another reason when we should sell some and then go about choosing, consolidating all your money in fewer well-performing funds.
You mentioned one of the reasons to look out for is the performance of the fund and the rating it has got.
Yes.
What are the measures? I mean, what are the, okay, let me not say measures, let me say how are funds rated? And then how should we know that, okay, it has come from 5, say 2 or 3?
Yeah.
If it has come down, what could be the reasons for it coming down?
Yes. The primary driver of our rating system is one that it is completely quantitative. It is based on numbers. There is no qualitative input. We are not sitting there and actually thinking that this fund has stopped doing well. It is not a subjective opinion. It is entirely based on numbers. The numbers are, the formula that we have that we devised in 1993. We have been rating mutual funds since 1993.
Still holds good?
It has undergone a great deal of refinement over a period of time, because then there used to be only closed-end funds, and then the emergence of open-end fund, then the classification system, which is the bedrock, which is the basic foundation. Because the whole premise of mutual fund rating is that we are comparing relatively superior, consistent performance of a certain kind of fund. So, first and foremost, you cannot compare a 5-star equity fund with a 5-star balanced fund. A 5-star balanced fund means among the balanced fund, this has delivered the best risk-adjusted performance. That does not mean only performance, because when you look at returns, you are only looking at performance. This means how volatile it has been, and how volatile it has been compared to other funds of similar kind. So it is just a yardstick to measure how consistent it has been. So performance is also factored in that. So I would say that one should, the starting point of the rating system is that it is a good filtering mechanism. If you go about choosing a fund, start from a universe of 5-star and 4-star fund, which means eliminating the 3-star, 2-star and 1-star is a good way of looking at it. It narrows your universe. It makes your life easier. And funds to avoid, I think that's the first service it delivers. Then comes whether it should be used for a tracking or monitoring. Yes. If a 5-star fund remains a 5-star fund, I don't think there is much to worry. Or a 4-star fund remains slips from 5 to 4, I really won't bother much. Slip from 3-star to 2-star, I'll worry, and I will definitely ask more questions. And I'll be reasonably, and if it stays there for 6 months, I'll be inclined to sell sometimes.
You mentioned about if the fund has done very well for, say, 10 years, 15 years, and if it is not doing well for the past 1 or 2 years, how much time should we give to that fund before withdrawing from it?
15-year, 20-year-old fund, I will be willing to give it, 2 years in 2-star and 2-star rating grade. But if it's a 5-year-old fund, was a 5-star fund, and then slips gradually to become a 2-star fund, then I think I will not wait for, and if the fund manager has also moved, then, so I will be looking at fund manager changes and how old it has been. Because there is a possibility that when you are looking at a 5-year, 6-year cycle, the fund would have just hit upon some great, I'll be primarily looking for the design of, whether some design has translated into performance or whether it is an accident. And that accident can, in market, an accident can actually boost your performance for 2-3 years. And there may not be a great design behind it. It may not be the fund manager's brilliance sometimes. So he just might be lucky, or he just hit upon something, and that has exaggerated, or a substantial impact on performance, and it lingers over time, and it actually gets factored in all your performance calculation all the time. So I will be worried about if a fund slips from 3-star to 2-star and stays there for 6 months, 1 year. I'll be inclined to, and I'll definitely use it as an opportunity to delve deeper.
Okay. And in our last program, we talked about how we should be withdrawing our money from mutual funds, so that the ways of doing that remains the same. Quickly, in one line, if you can tell people how to withdraw.
The systematic withdrawal plan for your income needs. I think, that's the finest thing that can happen. Mutual funds become a great vehicle for somebody to convert your regular cash flow into a pool of capital, or a pool of capital translating into a cash flow for you. And that is how it should be used. If you invest a large sum of money and want to derive an income from it, the market decline should not bother. Yes, but you should be concerned about the amount of money that you are withdrawing. If you take out a lot of money, you will actually impair your capital. You must withdraw conservatively based on your needs. I think 4 to 5% is a conservative estimate, which should be the annual withdrawal rate, and you should revise it depending on. And if you do it like this for 2-3 years, your capital grows, and if your capital grows, then you'll be able to withdraw on the higher percentage. Assuming that you have 5 lakh rupees and you take out 2.5 lakh, 50 lakh rupees, of which you want to take out 2.5 lakh rupees a year, which is about 5%. So if the remaining 47.5 lakh rupees will appreciate more, next year you can revise the 5% of the revised amount, the 47.5 lakh which is appreciated, whatever is left over, the higher the amount. So by devising this kind of a conservative withdrawal mechanism in initial years will ensure that you are able to grow your money faster. You have enough capital, and this is one of the simplest way whereby from a pool of capital you will be able to ensure inflation adjusted income for yourself.
Correct. So we're talking about how to withdraw from your mutual funds, and one of the questions that I have now for Dhirendra is that what if I have multiple funds? What should I do? Which one should I offload first?
Same yardstick.
Which you touched upon a while
consistent performance. So if you have many funds, choose the best of the lot. There are two things, when you are doing this exercise, you should be careful about two things. One is the exit load. Most equity funds and balanced funds levy an exit load if you redeem your investment before 1 year.
Correct.
So make sure that if you have been doing your SIPs, or if you have made a lump sum investments, or if some of your SIPs have been discontinued but your money is not old enough, make sure that they become 1 year older. So that there is no exit load. Otherwise, it generally varies from 1 to 1.5% or 2% if you take your money out before 1 year. It is also tax inefficient. All the gains that you would have generated on those investments which you redeem before 1 year, 15% short-term capital gains. So 15% of your gains will go up on account of taxes. So these are two things which one investor should plan and actually try and avoid it.
In case of debt funds, as you just mentioned, which one should I exit first? 3 years, or the ones which have just one is 1 year old?
Debt fund is a different thing. Debt fund is one about debt fund. The selection of debt fund, the most important thing is the time frame. Your investment time frame must match with the appropriate category. If you are investing for a few months or few days, then the right kind of fund, and I don't think you need to really sell it. It is generally a need-driven investment. Then comes, if you want to really make it efficient, in terms of withdrawal, then you have to hold it for 3 years. Otherwise, there is absolutely no advantage of investing in a debt fund on tax efficiency.
Correct.
And tax efficiency actually is a big edge for investors, because you are able to convert your taxable interest income by holding it in the form of a mutual fund. It actually becomes a capital gains and far more tax efficient.
And for that 3 years is important.
For that 3 years is mandatory.
Okay. So how to withdraw from mutual funds is what we discussed, and if you have any query, then you write into us as the way you've been doing previously, and we would be taking your questions at this point in time. And we want to reiterate that Investor Hangout is brought to you by Aditya Birla Sun Life Mutual Funds and Value Research. First question from Amit, who says that he has a mutual fund portfolio maintained from the last 7 years. He's planning to purchase his first home and wants to withdraw some money from it. What factors should he consider while selecting funds for withdrawal? First home?
No, what? Sorry?
First home?
Yeah. One is that he should, most people should target to buy a home they plan to live in.
Yeah.
And no more. Don't consider it as an investment. That is something which will, it may not be the finest way to invest your money. But more importantly, how to go about, how to choose funds. Choose the conservative ones, the ones, and also use this as an opportunity to exit the funds which are relatively poor performer. I think this should be the criteria. And if you have a great portfolio and the market is at a levels, and if you are partially going to withdraw, which will fulfill your need for the down payment of the new house which you plan to buy, then take that money out proportionately. If you just have 4 great funds and you are investing regularly, take money out based on your need. If you need 10 lakh rupees as the down payment, then take out 2.5 lakh rupees from 4 funds. Continue with your investment plan.
Okay. Kamal has written to us, what charges are deducted from investors at various stages under the heads of expense ratio, entry charges, management fee, exit load, including all hidden charges?
Mutual funds are relatively clear when it comes to, in the last 2-3 years, SEBI has cleaned up. That doesn't mean the costs are coming down. Costs are high, but there is no hidden charge. There is a single charge generally, possibly 2 charge. If you invest in a mutual fund, there is an all-inclusive expense ratio. The charge that you see as expense ratio, and this expense ratio can vary for the regular plan and the direct plan.
And what percentage is that?
It could range, for equity fund it could be 2.5%.
Okay.
And for the direct plan of the same equity fund, it could be 55% to 75 basis points less.
Okay.
So it could be 1.75% for the direct plan, 2.5% for the regular plan. It is substantially lower in case of debt funds, and that is the all-inclusive charge. Then there is the exit load. Of course, this expense ratio that gets reported every 6 months generally. They also take into account, this 2.5% plus GST, plus there is a B15 incentive, which is which is factored in. So for a very small fund, it can well go up to 3%, but the fund company actually charges up to 2.65 based on the other levies that is possible. But it's a clean single charge. That includes the management fee, that includes the sales expenses, that includes the operating expenses, the registrar fee, the custodian fee.
Okay.
These are the 4-5 broad heads for which, but there is a single charge. Then there is the exit load. If you redeem your investments before 1 year in case of equity fund, and the time period can vary for various other funds. For debt fund, it could be, for liquid funds do not have any exit load. Right. For any, they're planned as something, as a overnight investments as well. But other funds, other kind of debt fund, they can have for exit load for investments of less than 1 month, 3 months, and so on and so forth. So there could be a complex exit load structure. But exit load gets back into the mutual fund. It is not an earning for the fund company. A single charge for the fund company on account of managed expense fee. The exit load gets into the fund itself. So it actually benefits other investors in the same fund.
Okay, but not you, since you withdrawn.
Yeah.
So, okay. Interesting question from Mr. Chaturvedi. He asks, when switching from one fund to another can be considered as long-term capital gain?
No. In fact, our tax laws are such, they are defined that, if you're switching from one fund to another, it's very straightforward. You are selling one fund and buying a new one. So you have to acknowledge your capital gains then and there. If the fund from which you are switching from, if it is a less than 1 year old investment, it will be not considered. So it depends on the age of the investments.
Okay. Colonel Vas says that if he's invested in a 4 to 5 star rated mutual fund whose rating has subsequently come down to 2 or 3 star, should he be exiting the fund? If you have go back to the opening 5-10 minutes,
Yes.
you would have got the answer.
Yeah.
Nonetheless, I will still ask Dhiren to give us.
Yes, I would still like to answer this because this is a question which we get very frequently.
Yeah.
That a fund slips from a 5 star to 4 star, I won't bother much. Stays at 3 star for a while, I still won't care. I still won't bother much, but I'll be prompted to think that what is going on. And slip from 3 star to 2 star, I'll worry. I'll aggressively look for a reason and try and satisfy myself that is this fund still worth remaining invested?
Okay.
If I don't get very convincing answer, and because
I'll
that will be a
exit.
stage when I will have very compelling alternatives to choose from, and so I'll switch to the alternatives.
Okay. Hemant says that when one has over-diversified into 15 to 20 mutual funds, okay, how does one select which mutual fund to consolidate into?
It is not very uncommon. We start with the whole thinking that mutual fund is a good thing. Then
More the merrier,
yeah, too much of a good thing may not be a good thing, because what happens as a result of this, if you have 20 funds, then you are likely that you will almost be like a quasi index fund, and index funds should be available cheap. You are actually holding these funds and paying money for active management, incurring a cost of 2.5% to 3%, and getting an index fund performance. And there are other psychological barriers to it. When you have too many funds and too many funds also means that you don't have special interest in some funds. When you have 25% of your capital invested in a fund, you will be interested. When you have 5% of your money in something, you will actually not be attending to it if it is not doing well, or you will find an internal justification. You will actually persuade yourself that, okay, doesn't matter, it's a very small part of my investment. So don't have too many funds. I think 2, 3 funds, 4 funds actually get you enough diversification. By virtue of, I would say that a multi-cap fund and a small and mid-cap fund, or a mid-cap fund, if you have 2 of each of these, the underlying portfolio can well be something like over 100 stocks, which is good enough diversification, entrusted to good fund managers. So consolidate these into 3, 4 funds. Use the same reasons. There are different ways in which you can actually achieve this consolidation. Many a times I come across these portfolios where people want to consolidate, and I don't have a straight answer. If somebody who is 60-year-old is sending me a portfolio of 15-20 funds, I normally encourage him to move into 2 to 3 balanced fund, because it will get him the fixed income allocation, it will get him automatic rebalancing. It is actually a great simplification and great diversification at the same time. Great tax efficiency, because you don't have to worry about the rebalancing yourself. It will happen automatically there. So that is meant for the conservative investor, and a lot of people actually don't buy into this simplicity. They think that it's a compromise on sophistication. You don't have to be sophisticated. You have to be very simple. It must work, and this is something which really works. Then comes for somebody more aggressive, I would suggest him that two 3 mid cap and small cap funds and 1 or 2 multi cap funds can actually give you 5 funds in all, can get you great diversification. And if you have to invest in a tax saving fund, one of the tax saving funds should be very much part of this only. So no more than 5 funds, and you will get great diversification, great skills at work for you. Then you want to further simplify it, somewhere in between, then maybe consider just 3 or 4 multi-cap fund, and that will be good enough. So first decide on this, which path you want to take: more active, more conservative, or the balanced fund route, or mid and small cap, mid and small cap and multi-cap funds, or just multi-cap funds. If you are able to do this, then choose the best of the lot and choose the ones which you have, which you already have. Consolidate in 3 and 4 funds, and that will be good enough. You will be completely taken care of. And sticking to the plan through the lean times is the most important thing.
In a nutshell, what Devendra is saying, as we say in marketing and advertising, keep to the KISS principle. Keep it simple and straight. Right?
Yes.
Okay. We have the next question from Makran, then says that while withdrawing from funds based on SWP, can one give instructions to withdraw based on target NAV level? For example, NAV up by more than 10% a year, that fund should be taken up.
Maybe not, if you have some certain principle to this, because the big gains come your way when you least expect it. In fact, what we were talking last week, that you have the 5-year return from equity, and 1 year it went up by 45%. So if you took your money out just after the 10% gain, you would have lost the remaining 35%.
Absolutely.
So there's a great opportunity loss. Likewise, there is a problem whenever you try and put stop losses and actually profit ceilings, because it's very hard to after, if you put a stop loss at 5% and the fund falls by 6%, and after that it sees a big turnaround, but at your stop loss got triggered at 5% and you took your money out and you were deprived of all the turnaround. That is why these are all timing tactics. Don't do it.
Okay. Keep it simple and straight. Okay, Mohan asks how an SIP in a growth plan differs from an SIP in a dividend plan of a mutual fund.
No, it's no different, except that SIP is a way to accumulate, and why you should choose a dividend plan where you get a part of your money back. So it doesn't make sense. While you are accumulating your investments, there is no reason why you should be investing in a plan whereby you get a part of your money back. Dividend from a company is different. Dividend from a mutual fund is very unusual. You just get a part of
right?
No, when it comes to dividend from a company actually indicates a lot of things. There is never an arithmetic relationship. A company gives a dividend. The price does not get adjusted exactly by the precise amount of dividend. In case of mutual fund, it is precisely exactly that much, to the third decimal point. If you invest in a fund whose NAV is 20 rupees and next day it decides to give you a 2 rupee dividend or a 10% dividend on the face value of 10, next day itself the NAV will actually become 18 rupee and you will have 2 rupees coming into your bank account.
So SIPs are same, whether it's growth or it's a dividend plan.
You should not choose the dividend plan, because the whole idea of doing a SIP is to
That's
accumulate.
Important, huh?
Accumulate. And if you choose the dividend plan, you are, on one hand you are investing, and on the other hand you are getting a part of your money back.
Okay.
So it does. You should just go for the. Of course, you can do your SIP in a dividend plan and feel happy that a part of your money is coming back and you think that the money is productive. But dividend from a mutual fund does not necessarily mean that your money is productive. Performance is.
Okay. Let's move on. Vidyasagar wants to know if the AUM of the fund should be looked at during fund selection. He says that larger the fund, more is the dip in performance. So how big is too big?
This is a question which will vary depending on kind of fund. If I'm investing in a liquid fund, I will think that bigger the better. It will have far greater stability. It will have far superior ability to withstand a big shock or a credit exposure, which doesn't work out nicely. When it comes to a small cap fund, I would say that bigger is it's a winner's curse. A small cap fund gets more money because it does well, and because it does well, gets more money, it becomes unmanageable. There could be liquidity issues there. If a small cap fund is getting too much money and goes beyond 2,000-3,000 crore, I have seen that they often struggle, that the portfolio becomes too diverse, too big to manage. Likewise, I have also found that many great fund managers, they struggle as their fund gets bigger. In a large cap fund, I won't bother much, because large cap funds, even 10,000, 15,000, 20,000 crore can be managed actively. The fund manager's preferences can be reflected there. There won't be a liquidity issue. So it varies for different kind of fund. And generally speaking, I would say that if it's not a large cap fund or a multi cap fund, a small cap fund, I would say that in today's market cap, also these numbers which I'm referring to, they will change with times, because our market cap, the kind of company that we have when the market was at 3,000 on Sensex, and today when it is at 30,000 on Sensex, it's different. You have different kind of companies and far more capitalized, well capitalized, or companies with large high market capitalization. So I would say that for large cap fund, 35-40,000 crore might be good, might be still be okay. For a multi-cap fund, I think a 20,000 crore fund could be the ceiling.
Okay.
For a small cap, I think 3 to 5,000 crore fund will become beyond 3,000 crore. It will become a struggle to manage.
Okay. Very well defined, and we move on to our next question. Prashant asks if it is possible to establish any relationship between the type of equity fund selected and the time horizon for the investment.
Yes, I think if it comes to, of course, for any equity investment, I would like to think that 5 years is the bare minimum. Before that, you don't really get a full market
And that's
cycle.
what we
That
touched
is what
upon last
how long
time.
is long term, and the essential long term is 5 years. Anything less than that is, I would say that you have more conservative vehicles to choose from, not equity. And then comes then I don't think it's a matter of time. I think one should be then looking at temperament. There are people who are extremely comfortable with big swings in the market, in the value of their investment. They can well go for the small caps and the mid caps, and they will be rewarded more. For the big ups and downs that they can absorb, they can actually get rewarded more. There are people who want to keep it simple. A balanced fund will get you reasonably good return with great simplicity over any 5-year time period, with substantial risk of loss being, the possibility of risk of loss getting reduced substantially, and that should be the goal. So I think it is more a matter of your experience with the market, and it is not just a matter of experience in the market. There are two things which I think matters or bothers individuals more. Your experience in the market. If you have seen one full market cycle, if you were an investor before 2008, your belief or your belief in the market will be different. Your ability to stick to your plan will be stronger.
Right.
Then comes how important is that money. You will be extremely concerned about the money, assuming that I'm investing 3,500 rupees a month, and I have done this for 4 years. This is the only money which somehow I have been able to save, and this can cause a great difference to my life, as compared to 3,500 rupee invested by another person for whom it is just another investment, and he has many other assets and a very different time scale, investment scale or income scale. It could be so. How important that money is, and how your own experience. I think these are two crucial things which matter substantially for investors.
Okay. One last question. What is better to invest, multicaps or index funds for a 20-year horizon? And this is from Saurabh.
If you are able to spot that great fund manager, choose the multi-cap fund. Maybe at some point index funds will become interesting and they will be able to build a case for themselves. Not yet. Today, when we look at 5-year, 10-year, 15-year, 20-year performance track record of the multi-cap funds by some of the managers who are still managing their money, they have been able to beat the index by a wide margin. The case for indexing in India is not ready yet. So go with the select set of multi-cap fund, not index funds yet. Maybe 3, 4, 5 years, things become more efficient. It might be a worthy consideration, not now.
Okay, it's time for us to wind up now. I hope that you have understood and you know how to react when you have market fluctuations coming your way, and you know when to withdraw from your mutual funds. Thank you so much, Dhirendra.
Thank you.
We will be with you next week in Investors Hangout. Till then, goodbye and keep investing.